Thank you for joining us here at Seafood and Brew for this week's briefing. What we're going to do today is just review over the unemployment or the employment situation report that came out last week, and then just take a look at where rates are, and then project out where the market foresees them going to over the next couple of years. So it'll be an interesting kind of tee up for your ALCO committee meetings in January as far as projecting out where interest rates could be at the end of this year and the next couple of years. So first, let's look at the unemployment rate. The situation report, we saw we had 148,000 jobs created in December, well below where we saw come out in November as well as in October here. But that 148 is fairly low when we look at the trend. When we look at the type of jobs being created, though, kind of similar from what we've seen back in November. We saw construction continue to increase, 27,000 jobs in November, 30,000 in December. Manufacturing, 31,000 in November, came down a little bit, but still above that 20,000 mark at that 25,000 jobs in December. Retail trade, however, we saw that drop off. It was 26.4 thousand jobs in November, and December came in at negative 20.3, so pulling off 20,000 jobs for that month in the retail sales. We continue to see strength in that healthcare and social services number for those jobs at 38.9 in November, came down but still above the 25,000, coming in at 29.2 thousand jobs for December. And then that leisure and hospitality growing at 29,000 jobs. So continuing to create the service-oriented, health-oriented jobs, as well as that good producing construction and manufacturing, which is what we need to really push us through. When we look at the overall average earnings, average hourly earnings up to $26.63, and that's up 2.5% above where we were last December of last year, slightly higher than what was anticipated, and showing just a slight bit of that wage inflation, but still below historical means. So we begin to see that happen. As for the unemployment rate, you can see it stayed the same. This is the third month in a row where we are at that 4.1%. The U6, the total all-encompassing unemployment rate, went up just 0.1% to 8.1. So overall for the unemployment rate, not much of a change, kind of hitting our low in here. When we look at how these numbers and a couple of other releases that came out last week impacted the Atlanta Fed's GDP Now released, you can see we're down to 2.7% on the Atlanta Fed GDP expectation for the fourth quarter GDP. We can see where the range in the blue chip economic indicators put it. We're right now, the GDP now is right in the middle of that at that 2.7. When we look at rates now, looking at where we've come over the last couple of years, back in 2015 is this dotted blue or dashed blue line. The dotted green line here would be last year, that's December 2016. And then this lighter blue solid line is December 2017. So these are the year ends. You can see the big change we had down here at the short end with the Fed raising those short-term rates, pushing up that shorter end of the curve, whereas long-term rates moved slightly, but in fact came down when you look ultra long-term 20, 30-year rates come down from where they were the past 3 years. Now looking out, when we look at the forecast here for the Bloomberg consensus, we can see where we anticipate the economists anticipate rates to be out at the end of this year, out in December of 2018. And you can see the Fed funds at 2.2%, the 3-month LIBOR at a 2.23%, 2-year Treasury at 2.34%, and then the 10-year Treasury at a 2.88%. That puts that spread between the 10-year and 2-year at just 54 basis points. So really starting to narrow down in that spread. And we look out to additional quarters to the first half of 2019, continue to see that spread decline between the 10-year and 2-year down to 47 basis points. So overall, we continue to have that expectation of those short-term rates coming up. Now, this is the, like I said, the Bloomberg consensus here. When we look at the forward curve, so this is taking the current yield curve and then looking at the spot rates and doing some bootstrapping and projecting out into the future, we can see similar trends where we have that narrowing of the yield curve. You see, this is where we are today, or as of Friday. This would be the 5th of January, the spot curve, and then we build the bootstrapping to get us the projected curves, the forward curves out 12, 24, and 36 months. And you can see out 3 years, very, very narrow. In fact, almost an inverted yield curve when you're looking between 1 month and 10 years. So it's very minor. Minor in terms of the spread. However, when we look at the impact potentially for banks, this is rather huge. We want to start thinking about this in our modeling or ALM. And we want to build these scenarios in where we have that short term of the yield curve start to pick up where the long term stays relatively flat, narrowing that curve to see how that impacts your overall interest rate sensitivity. Looking at the Fed funds, this is the WIRP function on Bloomberg, and we can see where the probabilities lie for the next couple of meetings in terms of whether or not there will be an increase in the Fed funds rate. This current meeting coming up at the end of this month, no real change expected, 99% probability that rates will stay where they are. However, when we look at March, we're expecting a rate rise, staying where it is in May. And then we come in the second half of the year, June, anticipate about a balanced, whether they'll raise rates or not, getting up to that 1.75 to 2% range by mid-year could be a potential as far as what the probabilities are in here. And then no real additional rate changes throughout the rest of the year. So this is where we see the Fed funds coming in currently for 2018, below what the Fed themselves expect to happen. That's what we have for you this week. We hope everyone's staying warm out there. We're kind of up here in the Northeast getting a break. We're getting into the 30s, which is very nice compared to where we were back in the teens last week. So we hope you all have a great week this week. Look forward to seeing you back here next week. Have a great week.